Can you believe that 5 million rental households across the country are still behind on rent? I couldn't believe it either. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is March the 20th. Randy Patrick here, putting the realism back at real estate. Hope you're doing well. I've been struggling with what videos to put out just because of all the financial crisis going on, and I guess you could say that it's kind of encapsulated right now. We're going to see things that are happening across the world, i.e. going to Switzerland, looking at Credit Suisse and those type of things. We know that a bunch of banks are still having some problems here in the U.S., but it looks like the federal government, Federal Reserve, has kind of got their fingers on the pulse and is doing the best they can to take care of things for us. All that remains to be seen. So yeah, anyway, as we go on, this came up today. More than 5 million households still behind on rent. Of course, what to do if yours is one of them. So as of February of this year, renters in the U.S. continue to owe $11 billion in debt. The average arrears is more than $2,000. And obviously this article is just talking about what to do if you're a renter and you've got some issues. With roughly 2 more months before the U.S. Department of Health and Human Services ends the 3-year COVID public health emergency, more than 5 million of the nation's households remain behind on rent. So $11 billion is a lot of money. It's according to the National Equity Atlas. On average, renters who are behind owe just over or just under $2,100. Now, of course, there's going to be information out there if you are renting and behind on rent. My point is that this has not been spoken about or talked about kind of at all since really the end of the sort of COVID pandemic. And what I mean by that is that when the final eviction moratoriums stopped or ran out, then it was kind of like we're not talking about this anymore, which shouldn't surprise people, but it, I guess you say, goes to show, and we should note that we got a lot of problems still out there. So we're in a situation where we've got inflation, we've got high cost of living, we've got shelter prices, CPI shelter is going up, which means rental prices are up. Also, we know that gas prices are up, food prices are up. Everything is up, interest rates are up, whether it's credit cards, car payments, whatever. So everybody's feeling the pinch right now. And basically it boils down to, what do you pay last? Well, here's what happens. You're going to pay your transportation costs first. You're going to, your food, heating and fuel costs, cell phone cost, transportation costs. And then at the end, we'll call it cost of living that suffers the most is accommodation or housing, whether that's rental or mortgage payment. So ultimately, again, this article is really based on helping renters seek assistance. Now, there really isn't much assistance left because ultimately all these, landlord rental assistance programs pretty much ended, after the pandemic. I can tell you that a lot of landlords I know didn't get paid, didn't get money. There wasn't money or couldn't get at it or wasn't processed by the entities that were doing the processing. Here's something here on Tuesday. The Texas Rent Relief Program began accepting applications for aid, but it's already scheduled to stop doing so Thursday. A notice on its website reads, within the first 24 hours of reopening, requests for assistance far exceeded available funding. So in the end, we can see that whatever assistance is available is not enough to cover all the people who are missing rent. This is a domino effect. You don't pay your rent, eventually you're going to have an upset landlord. The landlords then will get financially pinched and can't maybe pay mortgage or other items as well too, that are needed to maintain the property, taxes, insurance, whatever. So pure domino effect. But this really, guys, is what I call the typical wealth transfer model. Like, other words, there's no aid out there. A lot of times, depending on jurisdiction and state, it's difficult for landlords to evict people. There's a long process, depends on where you're located. So in the end, the property is going to become distressed or become financially unstable, which could lead to foreclosures or other issues here, right? Basically, when we know this, it says it's not a strategy experts recommend, but some tenants are using their credit cards to cover rent. Well, yeah, we know that. If you don't have cash, you're going to put it on credit. But we know now the credit volume or the credit available to people across the country is pretty much tapped out now. So people who have credit cards have pretty much tapped them out. Now they're into their payments and they're having to pay for higher interest rates and things like that. So not a good deal. As I mentioned, a lot of these programs that were in effect that were there to aid landlords and tenants that were really COVID era stuff never got money never came to landlords. So it's just a compounding problem, which isn't very good. And again, it leads to financial distress and it leads to housing distress as well too. So what I do think is interesting is that when you take a look at this number, okay, is that and we don't really talk about this because this is that nebulous number which is difficult to kind of fathom. But I showed this back in the day, and this is something that came out it was a press release from the current administration. The press release had to do with the extension of the eviction and foreclosure moratorium back in the day. So this was issued February 16th, 2021, and this basically was, I guess, the current administration said, hey, we're going to extend the foreclosure and eviction moratorium additional 3 months, but so they had a press release. So this was done back in February 16th, 2021. But I want to point out two important numbers here. So when we take a look at this press release, it says as millions of Americans face continued hardship due to the pandemic, we're going to help keep families in their homes. The pandemic has triggered an affordability crisis, which still remains today, essentially. Today, now, again, the article written today, which was Feb 16th, 2021, is essentially saying 1 in 5 renters is behind on rent, and just over 10 million homeowners are behind on mortgage payments. So if you think about that, we had 1 in 5 renters behind on rent, and that actually increased, and 10 million homeowners are behind on mortgage payments. So for those of you who I don't know how to put it in the right context here, but that don't believe we're in any sort of serious situations and the housing market just going to continue to go up and correct itself, well, I think you need to rethink where you're standing at, because we still have rental issues, okay? 1 in 5 renters, so is that, is that if 5 million is 1 in 5, is that 50 million renters in total? Who knows, right? But the whole point, 25 million, I should say, out there. I think there's more than 25 million renters out there, but we'll have to see. So again, if you have 5 million people not paying their mortgage, that's got a big trickle-down effect. And again, back in the day when 10 million people were behind on their mortgage payments, well, when we see these statistics like, well, only 500,000 people are facing foreclosure or are seriously delinquent, there's a big disconnect on the information. That's why when I go and talk about statistics, the fact that these numbers are very difficult to get our hands around and really understand truly what's going on, it's always worse than anticipated. It's always worse than statistically stated in the news media, all right? And of course, the news media, based on their narrative, is going to lowball or put things on a much less, I guess you could say, less negative spin, essentially, right? So that's the whole thing. So they're saying back in the day 10 million people were facing foreclosure. Put it this way, they all have not gone away in the space of 2 years, all right? There's a lot going on behind the scenes and a lot of legacy stuff still kicking around. But the interesting part to all this is that when you're going back to the how many people who are renting and who are missing payments, well, guess what? Lack of affordable housing has created a surge in rentals. So, this is where you kind of look at the news media and go, okay, what are we doing here? And this it's all over the place, right? So, we're having 5 million people not paying their rent. Okay. However, clearly the lack of affordable housing has created a surge in rentals. So the need for rentals and accommodation and housing for rental tenants, etc., is skyrocketing. So that sort of compounds the issue when you have that many people not paying their rent. I mean, where are they going to go? What's going to happen to those properties that are currently, occupied but not paying rent? I mean, there's just a lot of questions out there, a lot of concerns, but you can see things are not getting better. With regards to foreclosure, I'm going to do in my next video, we'll dive deep into foreclosures. But the interesting part about foreclosures and again, U.S. foreclosure activity declines in February, but continues to increase annually. Okay, so I want to put things here before people jump to conclusions. The activity declines monthly in February. So monthly compared to January of this year, it declined like 2 percentage points, 2 or 3 points, okay? Now realize that what is February? It's a shorter month. So the decline is pretty much because we had 3 less days of days where there could be foreclosure activity, but its growth is, X number of percent, and I'll talk about it in the next video I make. Its growth is more than the previous year. So we are growing in foreclosures. Obviously, we're going to be growing in evictions if 5 million people aren't paying their monthly rent. So you can see that the housing market is not getting fixed. It's getting worse. And we're not out of the woods yet, and the worst is yet to come. This just came out. The Federal Reserve is still expected to go through with a rate hike. So guess what? Even though we've had all these bank implosions and things have been corrected and taken care of and packaged nicely in the form of these non-bailouts, right, so to speak, recent bank failures have caused a crisis in confidence in the financial sector, but Americans are still grappling with stubborn inflation, which is true. And guess what? The Federal Reserve is now expecting to hike rates by 1/4 percentage point at this week's policy meeting. So in the end, everybody, once these banks were imploding, once Silicon Valley and Signature Bank went under the other week, all the analysts, all the news media was talking about, well, the Fed surely must need to pivot now. We have to go back to QE, and we're going to start seeing rate reductions. Well, this sort of says, no, we're not seeing that. The Fed's going to remain, resolute in where it's taken this financial market, and we're going to see maybe a 1/4 point rate increase coming up very shortly. So there you go. The Federal Reserve will likely approve a 0.25 percentage point increase this week's policy meeting. This will mark 1 year since the central bank began the current rate rising cycles. Over the last 12 months, inflation spiked to a 40-year high and has only recently started to ease. And by the word ease, it's only easing very, very little, still year over 6%. But all that monetary policy and tightening has been tied to issues that are disrupting the banking industry now. Obviously, we've got a high cost of living, and we're having a crisis of confidence in pretty much all economic sectors. So there you go. And by the way, folks, if you enjoy the information I provide, if you could help my channel grow, I'd really appreciate that. So please subscribe. And if you think you're a current subscriber, if you could please smash the subscribe button. Again, I'm losing more than I put on, always the case. So if you could do that, I'd appreciate it. Again, thank you. All right, moving on here, guys. This just goes to show the dynamic of the marketplace. So my point is, who do you believe? And it's kind of important here because we have conflicting information every single day with respect to every aspect of real estate. Some markets good, some markets bad. Some people don't see foreclosures, some see a ton of them. Here it just says, mortgage rates tumble in the wake of bank failures. So on the average rate in the popular 30-year fixed mortgage dropped to 6.57% on Monday. Right? If rates continue to drop now, buyers could return to the housing market once again. This mini banking crisis has to drive a change in consumer behavior in order to have a lasting positive impact on rates. It's all about inflation. Okay, it still is, but that's what happened on, I think it was the 8th, and then the next day on March 9th, mortgage rates tick higher on cool CPI report. So basically the Consumer Price Index report was released that very next day, and shelter, so CPI shelter, which is housing, the index reflects on housing, was not looking very good, and the overall CPI still showed a significant increase, even though it wasn't as much as the previous month. And guess what? So mortgage rates ticked higher. So we basically are seeing the contradicting news every single day. It's on the same day or a different day. So mortgage rates drop, mortgage rates go up. So really, it's tough to figure out this marketplace. I mean, I'm going to be honest here, is that, if you're just, as I said, the normie, the average person wants to buy a house, what do? You hear so many conflicting things. The market's dropping, should be dropping. But mortgage rates are still going up. Shouldn't they be dropping? My realtor tells me I should buy now. What's going on here? There's just so much going on. It really is a confusing time with respect to the bombardment of information we're receiving from the news media on a daily basis. But again, I just want to point out it's funny, within 24 hours, bang, dropping rates, raising rates. So again, it's what do you do if you're trying to figure stuff out on the fly, right? So it's pretty difficult as far as I'm concerned. So anyway, that's the scoop for that. And just as an FYI, luxury home sales plunged 45%, with Miami in the Hamptons hitting hardest. So the area, Miami, has been growing leaps and bounds, that whole sort of southeast part of Florida, just because it does, all right? And obviously when you have price increases and you have increases in we'll say median home price point and average, a lot of the stuff that's been driving that has been, we'll call it the blend of low to high level price point sales has been changing. So back a little while ago when we saw massive increases, it was because we saw a surge in the 500,000 and above marketplace. So more people were buying more expensive properties, which in turn was bringing the average and the median price points up. Well, guess what? Luxury home sales plunged 45%. In Miami, and the Hamptons are being hit hardest as well too. So clearly you got lots of luxury property out in the Hamptons, but if those things are sticking around and not moving and are slow to sale, then that's going to affect the marketplace and going to affect your overall median, your overall average price points. So that's what's going on. So again, sales of luxury homes dropped 45% during the 3 months ending January 31st, compared with the same period the year before, says Redfin. Tight supply and higher rates are pushing luxury home prices higher. Redfin defines luxury homes as those estimated to be in the top 5% on the estimated market value. So tight supply and higher rates are pushing luxury home prices higher. Maybe tight supply may, but rates don't push it higher. Rates make them less affordable. Maybe it's just a wording issue. But my point is that if you don't like what you see, you're not going to overpay for something, especially with today's rates. So yeah, there's even an affordability crisis in the luxury realm. Not everybody who buys a luxury property buys with cash or wants to buy with cash. They want to use leverage as well too. So there you go. So anyway, just goes to show that we got a lot of things going on in the marketplace, a lot of little micro issues happening, but this is what kind of goes on here is that for me, it's been if you take a look at, just before, COVID, the pandemic started, it was all really, really one narrative. Now we're all over the place with narratives. All right. I think in the end, what we have to do is to determine what's true, what's not true, what's just salacious, what's just, we'll call it self-serving type of articles and self-serving, news reports, etc. for various groups who are releasing information, I guess, and figure out where the market's going. Personally, I know where it's going. I'm very confident where it's going. We've already started to do what we need to do to work in that marketplace, and we're having a lot of success at it. So it's something I say, if you want to participate in the market that's changing, and whether it's changing good, bad, or indifferent, when there's change that brings opportunities, I can talk about this for hours. All right. So please reach out to me if you wish to engage. Lots going on. I've got a lot of stuff happening, a lot of deals, multifamily, single family, Airbnb rentals, training, build to rent, build to flip, all sorts of stuff going on here. Short sales, foreclosures, whatever. So if you want, reach out to me, Randy at luxuryshortsales.com. So once again, I thank you for the views, likes, and comments. Please share the video with your family and friends. If you're not a subscriber, if you'd please subscribe, I'd appreciate it. I look forward to talking to you later on this week. Thank you.